Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
All right. Well, hello, everyone, and welcome to the Millionaire Next Door podcast. Thank you so much for being here. We really appreciate it. We've got another terrific guest with us today, Peter Repetto. He is with iCapital. Peter, welcome. Thanks for being here. And why don't you go ahead and introduce yourself? Tell folks a little bit about what you do.
Yeah, Robert, thanks for having me today. So my name is Peter Repetto. I'm a Vice President and Investment Strategist here at iCapital, where our team is really responsible for generating not only our private market views, so kind of what asset classes within the alternatives universe we like, but also public market views. We do have a very large structured investment distribution team. So really helping them kind of identify, thematic areas within the market, but also sector views that we might have within public markets. So really providing that overview for our sales team and firm.
Great. Appreciate that. And as we were setting this up, you let me know that your team had just recently met and sort of did a big powwow and came up with a number of thoughts for a mid-year outlook and kind of what people can look forward to the rest of the year. Just to preface this for folks listening real quick, we are just coming up off July 4th. It is the 7th of July, and this may take a couple weeks to come out, but these are the thoughts as we head into the second half of the year. I want you to share some of those thoughts and let us know the big themes there.
Yeah, absolutely, Robert. I think it's probably helpful just to rewind a little bit. When we wrote our 2025 outlook, we titled it Solid Underpinnings with Plenty of Wild Cards. And now, as you kind of highlight, we finished the first half of the year. Probably a little bit of a debate on how economic growth evolved in the first quarter. The first half of the year, we did have that contraction in the first quarter. But by and large, it felt like growth held up relatively okay, especially the hard data. And it looks like the soft data is now starting to catch up a little bit, and we can speak about that later. And I think we all know, right? There were plenty of wild cards, especially as it pertained to the trade policy from the administration. And that definitely generated a lot of market volatility. I think if you look at where the VIX peaked out at the first half of the year, we reached 60 on the VIX. And then looking at the peak to trough decline on the S&P 500, we had about a 20% peak to trough decline. So certainly had a lot of volatility in the first half of the year. But, kind of where we closed the first half of the year, making new record highs, seems like we're not really concerned about trade that much. We did have some trade news over the 4th of July weekend. So we can kind of cover what that's going to look like in the second half of the year. But as we sat down and talked about that outlook, it was more, what are some of the things that investors have really been asking us? What are they thinking about? Or just what are some of the key questions that we had on our team? It felt like coming into the end of Q2, a lot of people are still focused on, what could go wrong in markets. And not that there's anything wrong with that, right? It's always important to focus on the risk. But we're also like, well, how could things go? What could actually get things to continue to move higher in financial markets? So that was kind of one of the questions that we're asking ourselves, and kind of became a two-pronged question given how strong the second part of the quarter was, just given the fact that we were back at record highs. So also trying to focus on what maybe some of the downside risks could be in the second half of the year.
Yeah. Share with me. I want you to share those thoughts. I'm just obviously April 7th, extreme volatility. We've had this comeback. Wild cards. I love all this terminology. I'm thinking about some of the topics we've covered on the podcast. We did have a couple folks who kind of mentioned some optimistic thoughts that seem sort of hard to get your head around. But, AI is driving an awful lot. But give us your thoughts on what you call tail risk for markets for the second half of the year. However however you want to couch this, it's been a hard one to follow because there was such concern. There were wild cards everywhere, yet it just continues to run back to growth. It sort of just keeps climbing this proverbial wall of worry and marches on. So maybe we can unpack that and really versus unpacking what's happened, rehashing that, maybe look forward of what the thinking is, where we're going to go next, where the puck's moving.
Yeah, absolutely. And so let me start actually with kind of the left tail risk, or what we think some of the downside risks would be first. And, I kind of joke around, but right, you brought up AI, and it felt like everybody was an AI expert from 2023 to 2024. And it feels like now when every meeting it was speaking about AI, not that that stopped, but it feels like everybody's now talking about trade. So the AI experts feel like they've become trade experts this year. And, I think probably the biggest risk, and it's not our base case, but I think the biggest risk as it pertains to what the outlook is in the second half of the year, obviously have stated how we've had very strong or at least very resilient hard data in the first half of the year. And the concern would be, a lot of that demand was pulled forward in order for companies to get ahead of the tariff or just the price increases that we could see. And if you looked at Q1 GDP, right, we contracted by about 50 basis points. But if you look at what the real contributor was to that drag in the first quarter of GDP, it really came from net exports. And if you looked at the import data that came in, I think imports rose by about 38% quarter over quarter, which is one of the largest increases that we've seen in history. So very clear that we saw a lot of pull forward in demand. And, the thought process is, given that you've had that could really keep, maybe make hard data look a little bit better than it appears on at least a go forward basis. So, right, hard data may be a little bit more of a coincident indicator. It's not necessarily going to be a leading indicator. So the concern would be that we could start to see a weakening in that hard data, especially given the fact that we have seen soft data weaken so much. It started to stabilize a little bit after the 90-day pause. But I also think, the other risk would be, right, if that starts to filter into the hard data. So, just tariffs more broadly speaking are making their way into the data. What does that mean for inflation? We know that inflation's been relatively muted. Feels like services are actually disinflating a little bit more, which actually could help offset tariff price increases going forward. But if those tariff price increases do go forward, right, that could change the outlook for the Fed. Then the Fed maybe remains in wait and see mode a little bit longer. Maybe that puts some upward pressure on rates, especially in the 10-year-old part of the curve. And if you look at some of the parts of the market that outperformed, at least in the back half of July, when it felt like, Governor Waller, Governor Bowman started talking about rate cuts, some of those interest rate sensitive or, more speculative parts of the market did outperform, so that could start to weigh on those, at least those categories, but also markets more broadly. And then I just say the final caveat would be, we're also starting to enter a weak seasonal period of the calendar, right? So if we do get kind of these headlines coming through, I think if you look at the S&P 500 between August to October, the average 3-month return is about minus 2.4%. If you compare that to the remaining rolling 3-month calendar periods over the calendar or just throughout the year, that's about 2%. So pretty big divergence in the spread there. So just given the fact that we could maybe get some headlines, over the course of the second half of the year or later in the summer, that could start to weigh on things a little bit. Again, not our base case, but just where we could see some risks fall in the second half of the year.
Yeah, we've really, everybody's looking at data. There's reports that come out weekly, but I don't really recall in 28 years where we're so data dependent. Everybody's so... And there's so little clarity, and everybody's waiting for everything to see which way it moves. It's a really, really interesting time with a lot going on for sure. One of the things in the notes we talked about, American exceptionalism, and that's a term. Maybe I wouldn't mind if you wouldn't mind explaining it. And where you think we are with that. That's been a phenomenon. And is this the end, the beginning, the middle? Who knows? What are your guys' thoughts around that?
It's a question that we've certainly got quite a bit of questions on this from our clients over the first half of the year. And I think it makes sense, right? The dollar sold off by more than 10% in the first half of the year. I think the S&P 500 underperformed the MSCI World Index, excluding the US, by 13.3% in the first half of the year. So just given the underperformance of US assets in the first part of the year, people are asking, is this the end of kind of this quote unquote exceptionalism? And, how do we define that? I think if you just look probably, post GFC to where we are today, outside of maybe 1 or 2 calendar years, by and large, we've seen US assets across the board outperform that of non-US assets, right? And if we think about the portfolio in an asset allocation standpoint, or even the equity bucket or fixed income bucket from a regional perspective, right, there's a lot of emphasis on diversification, not only across the cap space, but also across regions. And right, that could help provide some downside protection, or just based on history, that there are periods where we do get outperformance in non-US markets versus US and vice versa. It's just we've kind of been in this long-term trend where we've had more outperformance of the US relative to non-US. So a lot of people, probably have been favoring the US relative to these markets. And now, given that we might have an underweight in some of these non-US markets, people are asking, do they need to rotate back into these assets? But also more specifically, right, we know that we have a very large deficit. We have a lot of companies funding that with their allocation to treasuries. So, is there a case where actually maybe, these large countries, sovereign wealth funds, insurance firms, are they seeing the opportunity set in US markets? And we think that there are 3 reasons why we still think that it's probably too premature to declare the end of US exceptionalism. One, we just aren't really seeing it in the data. If you look at the recent bond allocation or bond auctions, specifically the indirect bids, or just another way to describe the foreign allocations that we're seeing, we really haven't seen any sort of weakness in that data. And in fact, they've actually probably been better than what we've seen over the last few quarters. 2, if we think about the structure of US markets, we have very deep and liquid capital markets. Again, thinking about large allocators such as sovereign wealth funds, central bankers, large insurance firms. What are the viable opportunities for those firms to allocate or to make up for that treasury allocation? And we just don't necessarily see that viable option that's out there right now. And then 3 would just be on more of the equity side, where we have, a market composition that really favors US outperformance relative to non-US. So while, yes, we might trade at high valuations here in the US, I think we're around 22.5 times on a forward PE basis, whereas, the non-US markets trade at a much cheaper discount. But if you look at what makes up our market, right, we have a lot of growth companies, we have a lot of high tech firms, and we know, again, that maybe there's some concentration risk with the Mag 7, but if you look at the return on equity in our markets, right, we have a return on equity for the S&P 500 that's, almost pushing 20%. If you compare that to, non-US markets, Japan, it's high single digits, so maybe kind of low double digits for other non-US markets. So we think that there's a reason why the US trades at a premium relative to non-US markets. And then also just looking back at the most recent earnings quarter, we've had a lot of positive commentary on AI, and also looking at the hyperscalers and how they've maintained their CapEx forecasts for, investing in AI. We continue to think that showed that the AI theme is still alive and well, despite the fact that we had the DeepSeek news at the end of January. So again, just thinking about the fact that we do kind of have that tech exposure and AI exposure in the US. If we do continue to get some outperformance here in the back half of the year, we think that can help close some of the underperformance we've seen in the first half of the year.
Great. And I want to ask you to comment a bit on, I guess, opportunities where you see going forward, or your firm sees after this conference, with respect to, public markets, private markets. You mentioned endowments and sovereign wealth funds, insurance companies. That's where those kind of alternatives tend to fit in there. We've talked a lot on the podcast about the democratization in that space, and we're not really here to serve sovereign wealth funds. we're kind of serving the millionaire next door, the overnight 25-year success story.
Yeah.
They're now able to participate in ways with very good liquidity, minimized tax implications. It's really but are those good opportunities? What are you seeing for allocation of capital as the most attractive spaces that maybe do the best job of avoiding some of the pitfalls or, of high valuation, higher risk, all those things combined? I'll let you share your thoughts on that.
No, and I'd say let's start on private markets. And I think probably the most important aspect to start on this is let's just start from an asset allocation perspective, right? You hear everybody talking about the 60-40 portfolio. I think we can both agree that the makeup of the 60-40 portfolio is inevitably going to change over time. You brought up endowments, sovereign wealth funds. If you look at their allocation to alternatives, depending on the fund, right, they could have allocations that are high as 40 to 50% of the portfolio. And we know if you look at the high net worth investor, that allocation is really probably closer to something in the 2% range, right? So if we think about just from a portfolio perspective, we're probably of the view that we'll get something that looks something closer to 50, 30, 20, meaning 50% equities, 30% bonds, 20% alternatives. Again, that will really be dependent on each individual investor, right? Some people may have different liquidity needs. They may have different planning needs. So that may not necessarily be the right approach for everybody. But by and large, we think that's a helpful framework to think about an asset allocation makeup for a portfolio going forward. I'd say within private markets, some of the areas that we are focused on, and Robert, I know I spoke about some of the left tail risks as it pertains to markets. I do think that we do have a slightly positive view on markets in the second half of the year. And I know I'm saying this right before we have the letters that are going out to 12 to 15 trading partners right now. So, this could maybe not age very well, but I do think that we'll probably be in the second half of the year, we'll have a bit more policy certainty than we did in the second half of the year. If we think about kind of what happened last week, we did have the signing of the the extension of the TCJA, which I think is now being called the One Big Beautiful Bill Act. If we think about the Fed, it does look like they're probably going to cut between 1 to 2 times in the second half of the year. So re-engaging with that rate cutting cycle, which could help maintain some version of a soft landing that we've been experiencing over the last year. And then even though trade policy does remain up in the air and what that's going to look like for the second half of the year, we do know that the administration is trying to get deals done. They have announced some memorandums of understanding with Vietnam. They signed a deal with the UK. They're still largely agreeing to the Geneva deal with China. So it seems like trade policy is at least heading in the right direction. So what does that mean? If we get more policy certainty, that should help improve IPO activity, should help improve M&A activity, or just exit activity more broadly speaking. And I think in Q2, you did start to see some signs that this was stabilizing. But just as you do get more policy certainty in the second half of the year, we think that momentum should be able to build in Q3 as well as Q4. So thinking about an area in private equity that we're focused on, or at least have a favorable view on, that would be middle market buyout. Now, while the valuation argument relative to large buyout, they're at a slightly a slight discount to largely trading in line with large buyout. But if you think about scaling that over the portfolio, that could have some very significant ramifications. An area that we are very focused on as well as infrastructure. And being a New Jersey resident, you don't have to look much further than Newark Airport to understand that we need some updates to our infrastructure. And I think some of this gets back to the deficit argument to where, not all these projects are going to be able to be funded by the federal government or let alone state and local governments. We know that a lot of these general partners or GPs are sitting on quite a bit of dry powder, but also within infrastructure, very focused on digital infrastructure. Thinking about data center demand going forward, I think data center demand as a percent of total power demand is going to make up 8% by 2030. And also looking at the amount of money that will be spent on construction for data centers, that's expected to reach $49 billion by 2030. So it just feels like the opportunity set in digital infrastructure, the build out of data centers will only continue. And then the last item for us in private markets would really be on asset-based lending or ABL. So thinking about private credit or direct lending, a lot of these general partners are sitting on a lot of dry powder, and there's been a limited number of deals. And if we think about the total addressable market for direct lending, it's about 1.8 trillion. If you look at asset-based lending or ABL, it's about 32 trillion. So, and even looking at the penetration rate, still relatively low. A lot of these loans, are amortized over the life of the investment. So the principal is getting paid over time. And also because it's being backed by a hard asset, that should help with the loss rate relative to other parts of, public credit, let's say. So I think that's an area for us. And also because it makes up so many different parts of lending, whether it's royalties, aviation leasing, there a lot of other areas such as healthcare, life insurance services. A lot of the investors can diversify their income streams over the number of different sectors, which if, again, we think about that from a portfolio context, should help, mitigate some of the volatility as well as maybe some of the downside risks that we could expect relative to other parts of just the credit part of the portfolio. And then I would say within public markets, like I said, kind of by and large, still have a pretty positive view on risk assets here. I think we still feel strongly about the AI power and AI software theme. But two areas where we are maybe warming up to a little bit more is just trying to have a bit more cyclical exposure in the portfolio. I think some of this has to do with, again, just the fact that growth looks like it's remaining resilient. We're getting some policy certainty, excuse me. And then if we think about, some of the administration's push in the second half of the year, we think they'll be a bit more focused on deregulation. So that should benefit sectors like financials. But also we know that the administration is trying to bring production back to shore, or is just going through this large onshoring push. So if we do have a build out of manufacturing activity here in the US, that should also benefit industrials.
Okay. No, that's super helpful. And just big picture, it sounds like we covered a lot of the risks, a lot of the concerns, a lot of uncertainty about policy, but it sounds like you guys are saying a lot of these things are starting to line up and come together. And overall, you have a more optimistic look, and the fact that the market's rallied and these things are improving, you think that's justified. Is that a fair way to encapsulate it, or maybe you could put it in different words if needed?
No, I think that's a good way to put it. I mean, I think you said it best. It does feel like things are starting to align, and for the first time this year, it feels like kind of everything is maybe kind of lining up as we'd expect. And just one thing I'd broadly say from a market standpoint is if we think about where fair value could be on the S&P 500, right? Mm-hmm. We're now halfway through the second half of the year. So if we think about the importance of a blended forward metric, not only on a PE basis, but also earnings, one of the risks was with all the tariffs that were announced on Liberation Day, that would basically result in, no earnings growth for this year, or, very little earnings growth for 2026. Given the fact that it does look like the effective tariff rate is going to be lower than what was discussed on Liberation Day, that should mean that, we should start to return back to projecting some sort of earnings growth. And if you actually look at earnings revisions for FY22, or at least upward revisions relative to downward revisions, we've actually moved back into positive territory. So for us, it looks like 301 or 302 on a forward or 2026 earnings per share looks reasonable. And if we put around a 22 multiple, or even just assuming a 20 multiple, which 20 sounds very high, but if you look at the last 5 years, that's been about the average multiple on the S&P 500. That could put you in the range between 6,400 to 6,600. And again, that's more fair value. So if we do get rate cuts coming back in, the policy environment's a little bit better, maybe you can trade a little bit above those levels. But that does represent some marginal upside relative to where we ended the first half of the year. So, again, getting back to kind of the overall view, slightly positive risk tilt to the portfolio.
What else? Other big takeaways? Do you guys feel interest rates are warranted? Did you come away with the conclusion, or just more the likelihood? I know Powell and Trump are really, they may not be best friends, but it's an interesting time. Let's put it that way.
Without a question. I mean, we know that Powell's does not like talking about the president at this point based on the number of press conferences and questions that he gets. But, kind of I think there are two ways to probably answer that question. If we think about where we are from a monetary standpoint, it does look like we probably should get some form of cuts. And I think that there's two ways to categorize that as good cuts or bad cuts. So if the Fed is cutting because we do have inflation returning back to target, that would be a good cut, right? They're largely just trying to return their interest rate back down to a neutral setting to where they're not restraining growth from an economic standpoint. And one of the reasons why we think we could see this happen, even despite the fact that we could have some form of tariff pass through in the second half of the year, and that's something the Fed is looking for, is because one, it's taken such a long time for tariffs. We just haven't really seen a lot of tariffs, quite frankly, in the hard data. So whatever the spike is or pass through is to inflation, we do think will probably be smaller than initial estimates at the start of the year or even just around Liberation Day levels. And then also looking at some of the service data that we're getting, at least as it pertains to service inflation, it appears that disinflationary trend is in pretty strong shape. And if we think about the makeup of the inflation bucket, that makes up way more than what we're seeing in the good side. So that could also help keep a lid on inflation and, possibly allow it to return closer to target in the second half of the year. So that's one of the reasons why we think that we could get to this good cut camp. Now, the bad cut camp would be if the Fed is cutting because of weakening labor markets and they're responding to weakness. So, right, we know once the Fed falls behind the curve, it's very tough for them to catch up. So if they are ultimately responding to just economic weakness or weakness in the labor market, that would probably be a little bit of concern for markets. And what's interesting is in our mid-year outlook, we actually have a chart of how markets perform after a rate cut. And while, right, we know that the average return is typically positive the 12 months after, I think around 8%. If you look at non-recessionary scenarios versus recessionary scenarios, right, the divergence becomes quite large. So again, that gets back to, if they're behind the curve and they're trying to play catch up, that wouldn't necessarily be a positive thing. And I think for us, it seems like September, October feels rightly priced into markets for us where we could see the first cut. September still maybe a little early, but if we don't get that pass through from inflation as it pertains to tariffs, then that feels like it's probably right to us. The second way to answer that question is, what do we see from the long end of the yield curve, or let's just say the 10-year yield perspective? And for us, I think our answer here is going to be quite boring because our view hasn't changed. And we're largely of the view that rates, at least on the long end of the curve, we're going to remain range bound this year. Just because we felt like we had counter influences throughout the year where, if rates got to the low end, which I think we did get down to around 3.8% this year, maybe for us 4 or just under 4 feels like the low end of the range, and 4.5 feels like the high end of the range. So if we did get back to 4, markets would probably focus on, well, growth feels like it's remaining resilient. What about the deficit? That would put some upward pressure on yields. And then conversely, if we do get to the upward end of the rate perspective, are tariffs going to start to weaken growth? Is service disinflation coming in as expected? Is the Fed going to cut rates? And that could sort of keep a lid on rates as well. So for us, still kind of view the long end of the curve as range bound, and don't really see that changing just yet. Based on kind of where things are today.
Okay. Well, overall, you've got an optimistic view given everything you've considered with all these things. Any other sort of closing thoughts or key themes that really came out of this process that you had where you did this review, and just sort of key things people should be looking out going forward, and just sort of some closing summary, big picture stuff as we start to sort of land the plane here?
Yeah, no, and landing the plane reminds me of all the landings that we've talked about over the last few years, right? No landing, soft landing, hard landing. So, I think part of it is, I really think the bottom line of the piece is really gaining more policy certainty in the second half of the year. And I think as we get more policy certainty, right, it may not necessarily get sentiment measures back to what we saw coming into the start of the year, but it should start to put a floor under not only consumer sentiment, but also business sentiment that should hopefully give way to a bit more of an increase in animal spirits, which should improve exit activity, but also just kind of risk sentiment overall. And I think also once we start to get more clarity around trade, and it feels like we're not going back necessarily to those April 2nd levels, which I get as a risk given the kind of the news flow that we saw over the 4th of July weekend where, Scott Bessent was on TV and did talk about how, if some of these trading partners aren't necessarily negotiating in quote unquote good faith or aren't negotiating quick enough, then those rates would be back on the table. But the other caveat too was he also said how, those levies wouldn't be paid until August 1st. So that's still giving the administration some runway to work out deals. And just given the fact that we have seen them, have an appetite to get some deals done, we do think that we should gain kind of more clarity around the trade front throughout the second half of the year. And we think from a overall effective tariff rate, probably end up somewhere closer to 12%, or, so let's say 12 to 15%, than we necessarily do 20 to 25% like the forecasts were earlier in the year. So, just thinking about the hit to growth or even impact on inflation, right, that's going to be more manageable. And another important word for us this year was sequencing. And now since we're starting to get the stimulus behind the tax bill, that could add about 20 basis points to growth this year. So that should kind of help us around, kind of remaining around this trend growth or maybe just slightly below trend growth environment. And the one last thing I'll say is, even if the administration's at kind of let's call it a 10% across the board tariff, right, there's a very big focus on the deficit and what that means, right? It's going to add about $3.3 trillion to our national debt over the next 10 years. Well, if you look at the annualized annualized revenue that we're generating from tariffs, that's expected to generate about $2.5 trillion over the next decade as well. So while, yes, that will add to the deficit, the numbers probably aren't as large as what we think. So even thinking about some of the risks to, rates maybe going up much higher than where we're anticipating, we don't necessarily see that as the biggest risk right now.
Well, Peter, this is super helpful. It sounds like there's just a lot of data happening. We are in a very, very interesting time, as people can tell. Those April 7th, that volatility is very fresh, but it in people's mind and still very present with the risks, but things have really taken off and account balances are up at this time for sure, and there's probably a lot of dry powder. So there's many, many factors that those wild cards, I got to think there's still more out there, no question. But this has been a super helpful, and to put some optimistic, we'd heard some prior podcasts where that was said, where it seemed really hard to sort of see through the mud, but it sounds like an awful lot is still developing and changing. So perhaps we could have you back, at a future time when you guys have a little bit more, maybe you do your next update and just to give us overall thoughts, because it is a confusing time for a lot of folks. And we're here to provide guidance and, the need to grow one's assets and still fight off inflation, having just taken my family on vacation, eating out with, 4 or 5 people. It is shocking when the bill comes or anything, just filling the gas tank, hence the need to continue to work and generate income or capital. But this has been really, really helpful. Super appreciate it. And all your thoughts as you have a lot of alternatives available to us so we can look at different things. And really appreciate the thought partnership and hope this has been helpful. If you can share that piece with me, I don't know if you can, but that'd be great. I don't even know if we could put it in the show notes. We could talk offline if that's possible. I'd be happy to do that. But the puck is moving really fast. But this has been a great sort of summary to help people get their heads a little bit around it, around the perspectives of, you have a team, right? That's pretty decent size. That's a lot of folks going in rather than one person's opinion. So I really respect that. And thanks so much for being here. This has been terrific. Yep.
Yeah, absolutely, Robert. Really enjoyed it. And yeah, we should be able to provide you a link to the Midyear Outlook. It's going to get published today on July 7th. So be happy to send that over, and hopefully you can include that in the show notes.
That's fantastic. We'll make that available as a resource. Really appreciate and your contact info. Really appreciate it. Would love to do it again down the line. And thanks for being here. And everyone, thanks so much for listening. I hope you're able to get some good takeaways. If you like this, please like it. Please share it. Feel free to ask questions if we can give any more clarity around our thinking. But we're trying to watch this and monitor and markets and guide folks through their portfolios. And that's what we do on a continuous basis. So thanks for being here. Peter, thanks as well. And everyone, make it a great day.
The information discussed in this podcast is provided for informational purposes only and is not intended as, and may not be relied on in any manner as, legal, tax, or investment advice, a recommendation, or as an offer or solicitation to buy or sell any security, financial product, or instrument, or otherwise to participate in any particular trading strategy. This material does not intend to address the financial objectives, situation, or specific needs of any individual investor. You should consult your personal accounting, tax, and legal advisors to understand the implications of any investment specific to your personal financial situation. Past performance is not indicative of future results. Future results are not guaranteed. Alternative investments are considered complex products and may not be suitable for all investors. Prospective investors should be aware that an investment in an alternative investment is speculative and involves a high degree of risk. Alternative investments often engage in leveraging and other speculative investment practices that may increase the risk of investment loss, can be highly illiquid, may not be required to provide periodic pricing or valuation information to investors, may involve complex tax strategies and delays in distributing important tax information, are not subject to the same regulatory requirements as mutual funds, and often charge high fees. There is no guarantee that an alternative investment will implement its investment strategy and or achieve its objectives, generate profits, or avoid loss. An investment should only be considered by sophisticated investors who can afford to lose all or a substantial amount of their investment.